The deteriorating labor market, worries about inflation and tariffs, political turmoil overseas that's roiling government bonds, questions about the sustainability of the AI spending boom, not to mention a point-by-point recap of what happened to the price of Amazon shares from 1999 onward, and what it was like being on the trading floor during the 1987 stock market crash. This week's Money Show MoneyMasters podcast covers a lot of ground with two of the best in the economic and market analysis business. You're going to want to hear what they have to say and what it means for your investments as we head into the fourth quarter of the year. Joining me are Jim Bianco, President and Macro Strategist at Bianco Research, and Steve Sosnick, Chief Strategist at Interactive Brokers. Gentlemen, thank you both for taking some time out to chat. I want to kind of start with the jobs picture. I mean, that's been the story that certainly after the August report, and the number relative to expectations being very weak, and now we've just gotten these benchmark revisions, 911,000 jobs taken away from the prior tally. What are your thoughts on where the labor market stands, starting with you, Jim, and what do you think it's going to mean for markets moving forward?
Well, there's two things about the labor market that need to be delineated, and I don't think that many people are doing it. One, it's clear that the labor market has been slowing, especially this year. That revision number that you mentioned that came out this morning is for March of 23 or April of 24 to March of 25. So that's data that's now a year and a half old. And it won't get applied to the data until February of next year anyway. This is just a preliminary estimate. And these preliminary estimates do change, and they can change quite a bit. But the labor market has been slowing, and the jobs market has been weakening. But I'll say to you that that's like the irrelevant number right now. And what is the more relevant number is the population growth of the country has been dramatically slowing in the last 3 to 4 months because of the closing of the border. That matters a lot. There's 160 million people that have jobs. There's 212 million people between the ages of 16 and 64, which is what they consider the workforce. So what is the biggest driver of jobs in the United States? What's the population growth of the country? And right now, we don't know what the population growth of the country is. And we suspect that the population growth could be slowing dramatically. And we've got estimates. Goldman Sachs is now saying that 41,000 jobs is all we need to make in order to meet the current needs of the country. There's other estimates by the St. Louis Fed that's down around 30,000. American Enterprise Institute is arguing that it might be down around 0. So here's the uncomfortable question. Jobs market is slowing. We printed 22,000 jobs. Guess what? That's enough jobs. Fed doesn't need to cut rates. We're okay with 22,000 jobs if we have no population growth. And the reason I put it out that way is almost nobody's talking about the second half of the equation, because for decades, we never had to talk about the second half of the equation because we've never seen population gyrations like we have in the last few years. First, the big influx of people coming in, and now the dramatic slowing of people coming out.
Okay. It's an interesting take because, again, like you said, it's not something I've seen talked about all that much. But I want to pivot, Steve, to the Fed. I mean, obviously, we're having a meeting in about 9 days now or 8 days now as we're talking. We're going to get that announcement. The rate futures market was somewhere in the realm or pricing in 100 bips in cuts, maybe between now and early 26. Do you think that that's overdone? Do you think that's underdone? Do you think it's accurate? Kind of what is your thought on policy?
I think it's possibly a little bit overdone in terms, because remember, the market's been ahead of the Fed almost continuously. This point, remember, we came into 2024 expecting 8 rate cuts. We got the equivalent of 4. All year we've been expecting more rate cuts, and they've yet to really materialize. So that's fairly typical. Two aspects of it. Jim's points about the labor market, the sort of the stasis being okay, are important. Although it is interesting to note that people, older workers are leaving the workforce as well. I have a feeling that might have something to do with the fact that they can afford to do so, because in many, arguably, the stock market is helping them do that. But also, manufacturing jobs are lower. There's a lot of weakness underneath the numbers. So the labor market is certainly at best questionable. But the flip side is the other part of the dual mandate, stable prices, sort of lost in the shuffle, in the enthusiasm at Powell's Jackson Hole statement, with him more or less pivoting from tell me why I shouldn't raise interest, tell me why I should cut interest rates, to tell me why I shouldn't cut interest rates, which is of course meaningful. But the FOMC statement was changed basically to say the inflation target is 2%, not something over 2, not a 2 handle, it's 2. And that's not where we're trending now. The last 4 core PCE numbers, when taken out to 2 digits, have all been to the upside. We're going to learn from PPI and CPI this week. And if that follows the trend, or even if they come in as expected, that puts us at an annualized rate over 2%. And I'm not necessarily talking about the 12-month number, because that's 11 months of stale data. I'm talking more what the economists prefer is 3 or 4 month, annualizing 3 or 4 months data. And so I do think that the idea that the Fed is just going to be gung-ho about cutting rates might prove a little more difficult. And that's not necessarily a market-friendly aspect to it, because if the Fed is slow, that raises the stagflation-y type of questions. I'm not a believer in 70 stagflation hitting right now, but it's, stagflation light kind of thing, persistent, relatively high prices, and not a great labor market. And then, of course, if we do need massive rate cuts, I always caution, be careful what you wish for, because if you have an economy that's so bad that it needs massive rate cuts, that's not necessarily good for the earnings that drive stocks.
Got it. Jim, I want to talk a little bit about the shape of the curve, what's happened in the dollar, and the political markets interaction. How much of the steepening curve is just normalization? How much of it is, what's happening with the pressure on the Fed, the political pressure being brought by the administration? Any thoughts on what's happening there, and how things are going to unfold in the coming months?
Yeah, let's start with the dollar. The dollar decoupled after Liberation Day in April, where it was falling, irrespective of what was also happening. But that was very short-lived. By about May, it's recoupled with the bond market. And now what seems to drive the dollar more than anything else is if yields go down, then the dollar goes down. If yields go up, then the dollar goes up, and yields are going down. And that's why we've been seeing a weaker dollar. So it's more explained by the more pedestrian type of thing that we're just seeing lower yields and expectations of lower yields. It's not the loss of American exceptionalism. Everybody's abandoning the dollar or anything like that. I think that was a brief summer storm months ago, and that is long since passed. As far as the yield curve goes, it has been steepening, especially at the long end of the curve. The 10-year and 30-year have been steepening a lot more than, say, the 5 and 7-year part of the yield curve. And it's largely been steepening on what Steve was talking about with the stagflation story. You want to cut rates and the market's unsure about inflation, the long end of the yield curve is going to go sideways to higher, and the front end of the yield curve is going to go down, and you're going to wind up with a steeper yield curve. And that's what we've been seeing. It's usually a steeper yield curve, all things being equal, is associated with stronger nominal growth. Now, I use the word nominal. That could either be stronger real growth or inflation or a little bit of the others. Now, one last thing when you talk about yields, should mention foreign yields, because they're going up right now. And what's interesting about that is they're going up in I'm talking about the developed world now. They're going up in the developed world. The Japanese, the BOJ's hiking rates, they're going to hike rates again. Their long-term yields are going up. The ECB and the Bank of England have been cutting rates for a year. They've been doing exactly what Trump wants the Fed to do. And their long-term yields are going higher as well, and have been for most of the last year or so. So the rate cuts haven't been working. Again, it's fear of inflation. Their inflation numbers are a little bit sticky, even though they've got more of a stagflation story than the US, because they've been actually printing some negative GDPs in Europe. Also, they've got huge budget deficits. And then we've got a new thing now. We've got political risk that's coming into the equation. Yeah. For the first time ever, maybe ever, it looks like French 10-year yields they're within 1 basis point of Italian 10-year yields. France has never had a higher yield than Italy, and they're 1 basis point away from having that happen. And that's because there's tremendous political risk right now in France. Their government has fallen again. Their prime minister was kicked out. That Macron's going to have to appoint the 4th prime minister in the last year or so that the political risk is taking its toll. Now, why did I bring that up? If Europe is going higher in yields, Japan is going higher in yields, all things being equal, it will be a negative for the US. It will drag the US higher because developed country yields tend to move in the same direction. Not always, but more times than not, they tend to move in the same direction.
Got it. Steve, I want to pivot to you and talk about the equity markets here. I mean, this was supposed to be, everybody was sort of wringing their hands. It's August, September, seasonally weak. You got to worry about and maybe take some risk off the table. Yet we've been hitting highs. I mean, US markets are underperforming foreign markets, but in general, equities have shrugged off a lot of the threats. Why do you think that is? Do you think that's sustainable? And kind of how are you looking at things as we get closer to the fourth quarter?
Well, to some extent, there's the wall of worry idea that we've been climbing, and this market has been basically Spider-Man when it comes to the wall of worry. Just shimmy right up that wall. But overall, also, I'm only a believer in seasonality up to a point. Yes, there as the calendar starts to shift, I think it's natural for people to start to, at least institutional investors, to think more about capital preservation rather than strictly on returns, or add some risk aversion to the massive risk assumption that we've been seeing in markets overall. So that's relatively normal. But while September is clearly the worst month of the year, when you look back over a 25-year period, there are 4 months that have averaged lower returns. I don't have it right in front of me. I think it's January, February, I believe it's June, and certainly September. And September is by far the worst. The other three, are somewhere just slightly below zero. September's average is about 1.5% lower. But here's the thing about even September. Out of those 25, 12 of them have been higher. 12 of the average returns. So your seasonality here is a coin flip at best. 12 out of 13, obviously, 12 out of 25, obviously, is just under 50%. Now, last year with a 2% rally, we wiped out 5 straight bad Septembers, and those clearly are sticking in people's minds. But it's not, I don't love seasonality because it's one of those things that works until it doesn't. I think it's a guide, but it is by no means a hard and fast rule. There are other things to keep in mind. I think right now I'm hearing a bit more chatter about return of investment, of the money that's being spent on AI. If that becomes more of a theme, that could weigh on the markets because we're so dependent upon the AI trade. But that's really just a sort of a groundswell and undercurrent at this point. So I think so much more depends on our old friends Momo and FOMO, and what our friends at the FOMC choose to do in response to the various topics we've been discussing.
Okay. The next question, I guess, is kind of for either of you who'd want to take this. I mean, you mentioned tech and AI and whether there might be some loss of momentum in that part of the market. I mean, I look at things like the yield curve doing what it's doing. You would maybe argue that might be powerful for financials as sort of a driver. What are your thoughts on from a sector standpoint, how things shake out again as we kind of get towards the tail end of the year and people start placing bets for 26?
Oh, there's a lot of ways you can go with that question when you're talking about tech. I'm always reminded of the famous Bill Gates quote from the late 1990s, which was so true and applies today, that any technological innovation over the next couple of years will deliver you less than what you expect. And over the next 10 plus years will deliver you more than what you expect. And I think that totally applies when it comes to AI, that what all of this data center and infrastructure build out, the expectations of what we're going to get out of it in terms of profit, productivity, and the economy and the like is going to underwhelm us. It's going to be less than what we expect. But over the next 5 to 10 years, I think that AI is going to be as revolutionary as the internet itself, if not bigger. And I am one that thinks that, I've read estimates that up to a third of jobs in the current economy could be affected by AI. And I think that might be right. But I don't think that's going to happen immediately. And so the big thing that the market has to deal with is these companies are going to be dumping hundreds of billions of dollars into AI investment, and they ain't going to get anything out of it in 26 or 27 or 28. Maybe in 2035, it'll be a gigantic home run if they're the winner. but for the next couple of years, there's going to be very little. And I think that reality is starting to come into the market right now. And you just don't want to buy them all up because there's going to be winners and there's going to be losers. You can look at all the big AI spenders, and you're going to have to also make the case that a couple of these are going to fail and a couple of these are going to be huge home runs. And which ones are they going to be? And they're spending gigantic sums of money in order to try and be the winners. And it's going to be real hard to figure out which ones are going to be the winners and which ones are going to be the losers.
Steve, what would you add to that since you brought the topic up a little bit ago?
Sure. I mean, I think we're along the same lines here. I mean, for better or worse, we're all kind of veterans of the 1999, 2001 era, and I'll stipulate as Jim raised the point. The internet was everything that the most exuberant futurists were saying about the potential of the internet. It came true, but it didn't come true for several years. Bill Gates was right on this one by saying in the late 90s. And a lot of the big winners, as we know from that era, did not prove to be big winners. And remember, of course, the most successful internet companies of the present didn't exist then. Google didn't exist. Meta didn't exist. Microsoft was considered an also-ran. So some of these things, life has a way of changing. You think about someone asked me recently about the Nifty 50 stocks, and those were such one decision stocks, like tech stocks that were going to lead forever, like Polaroid and Kodak and Xerox, and need I go on? So the technology has a way of changing, and it's very unpredictable. And so I think, as I start to read more, there was the MIT study that only 5% of money spent by end users on AI has yet to pay off. There was another article I read in the Atlantic yesterday, just came out this week, that, in an early study, they asked coders, how much productivity they thought AI was going to add. And, one estimate was 40%, another was 20%. The reality was negative 20% because AI, as of now, still requires humans to realize that where AI makes mistakes, and it does make mistakes. Will it make those same mistakes 10, 20 years from now? I doubt it. But so this is part of it. So it's a transformation, but we've priced in the full transformation. The other thing to keep in mind here is the capital spending that's going on in AI is a huge contributor to GDP. And the earnings, and from these companies, from the big winners so far, and the market capitalization of these companies is such a huge percentage of the S&P 500 that we're very susceptible to a decline. And we did see a real world example of this in April when stocks fell. The bigger the stock, the worse it was. Like the Mag 7 was worse than NDX, which was worse than SPX, which was way worse than the equal weighted SPX. So, this is not to say the sky is falling, but if there's this rationalization of at least the questions being asked of how is all this money being spent? Is it going to keep increasing at this rate? And how much is the market depending on that increased spending? That can give us some bumps along the road. And I think, let's say as a longtime options trader, I do have to wonder if volatility the volatility measures are really pricing that in. And it's not clear to me that they are right now.
Got it. If I could add to that, just a couple of quick anecdotes to that. If you go back to 99, in 1999, Time Magazine's Person of the Year was Jeff Bezos in the coming internet revolution. And as Steve said, if you took the most optimistic scenario that they painted in that story, the internet exceeded it. It was way more optimistic than that. But here's the rub. In 99, this is pre-split Amazon. Amazon stock was $100 in 99. By 2001, it was $6. You had lost 94% of your money if you had bought Amazon in 99, saying, wow, the internet's going to be greater than anybody's wildest imagination. First, you lost 94% of your money. In 2010, it was still $10. You had lost 90% of your money for 11 years. Then Amazon went from $10 pre-split to 3,300. And I know I say this to people and it doesn't register with them. You'd lose 90% of your money for a decade and then you'd make 30x on your money. Oh, I should have bought the stock. No, you wouldn't have bought the stock. You would have fired every manager that put you in that stock 6 times over. This is the risk you face. It took the internet longer than anybody thought. But once it finally got traction, it was way bigger than everybody thought. And that's why I think AI is going to be at the same time. And I'll just reemphasize one other point that Steve said too. I could remember back in 99, we were talking about Cisco being the first $1 trillion company, which, by the way, it never has been. And we've got multiple $1 trillion companies. And that's because they were making the switches and the routers for the internet. They were the overused Wall Street term, the picks and shovels play, the hardware play. It's never the hardware play that really makes you all the money. It's the content play. It's when you invented Google and eBay and Facebook. And what do you do with the internet? That's where you make the big money. As far as AI goes, we're still in the infrastructure play. We're still buying NVIDIA. We're buying everybody who makes the chips, makes the stuff for AI. What's coming is companies that don't exist yet. The content companies that say, now that we have AI, what are we going to do with it? Those are the companies that you're going to have to wait for. And that's when the realization of this technology will really come to fulfillment.
Got it.
That was if you don't mind, that was exactly going to be my next point. Was the best AI company is probably being developed in a garage somewhere, maybe in Silicon Valley, maybe in Kansas, maybe in Chongqing. I have no idea, but that point is very important. Is I think the ultimate winner in AI it's probably yet to be acknowledged or even yet to exist.
Sorry, and that company, they still might be in school. The guys that are going to develop that company.
Oh, absolutely. Right, they might be they might be in gym class right now for all we know.
Yeah.
Exactly.
Yeah.
Well, I'd be remiss. I love the discussion of, the super high tech part of the market and the future forward part of, of what's going to happen down the road. But I have to just briefly pivot to one of the oldest industries, dirtiest industries out there. And that's things like mining, metals. We had another mega merger in the day we're recording this $55 billion tie-up. Metals have been phenomenal performers. What do you think about that part of the market? Do you think this is going to continue, or is this something that we're just getting too exuberant, maybe again in that old world industry at this point? And this is just for whomever wants to take it.
Go ahead.
I'll go on this one, if you don't mind, Jim. It's funny because I started my career trading international stocks, basically Canada, Australia. This was in the 80s, and so it was a big late 80s, big mining boom. So these names have been familiar to me for my entire career, and we've seen this come and go. The rally in gold, I think, is very specific, and the reason I say that is, to all the central banking types of points Jim raised earlier in the discussion, I do think some of the rally in gold is the fact that you're seeing central banks move some of their reserves into gold away from the dollar, and that's a much less liquid market than the dollar. So if it doesn't take as much to move it, and that's been providing a lot of the backdrop. Gold is always thought of as an inflation hedge, and it is if you live in a country that borrows in currencies other than its own. So the U.S., we can print more money. Japan, they can print more money. If you live in Turkey or Argentina or someplace like that, you really ought to hold some gold because they just can't print more money to pay their debts, and they have these perennial currency crises, and it's a way to diversify out of your home country. So from a U.S. point of view, I view it as much as an anti-dollar as anything else. So I'm not refuting gold. I do have a percentage of my portfolio, always have had a percentage of my portfolio in gold as sort of a diversifier. It has been a bit of a decorrelator. In terms of broader metals and mining and energy, that's more of a broad economic story. China has been the big push in terms of natural resources. Their economy, although they're trying to stimulate it, they're still in a bit of a deflationary cycle right now, which doesn't necessarily bode well. If the tariffs meaningfully hinder economic trade, hinder global trade, that doesn't help. So I do think that some of the, some of the more, smokestack type of commodities do have some trouble here. Even if gold has all the luster right now.
Got it. Jim?
Yeah, I'd agree with the comments about gold. Is that it is kind of. I've always said that everybody asks this generic question all the time. I'm uncomfortable with the financial system. How do I get my money out of the financial system? Well, prior to crypto, which is a way you could do it, the only way you could do it is gold, and you're not really all the way out. You're kind of only partially way out. So gold benefits when there's ever concern. One concern is inflation, but it's not the only concern. It could be deflation, it could be political risk, and the like. And right now, we've got a lot of political risk. As I mentioned earlier, we've got tremendous political risk coming out of Europe right now. I think a lot of Americans do not realize how fraught the political risk is between Germany, the UK, France. That Italy is the beacon of stability in Europe. That's all you need to know about how bad it is in Europe, that you have to look to Italy to be your point of stability. And then you've got, of course, the threat of independence with the Fed and tariffs and everything else. And it's no wonder that the instrument that you would associate with trying to get your money away from the financial system, precious metals, have been doing so well. And crypto, being another way that you could do it too, has been doing, relatively well over the last year. So this scenario will probably continue as long as this instability is with us.
Got it. Well, we're getting to almost being out of time here. I just want to briefly get to each of you. Steve, you're going to be joining us in Orlando for the Money Show we have coming up there, and your session is tentatively titled Happy 38th Birthday Fed Put. Can you just let our listeners or viewers know, if they come to that session, what they're going to be learning about?
Yeah, well, I like to say that I was there when I was like in the maternity ward when the Fed put was born, because I was on the trading desk at Solomon Brothers, and it wasn't the day of the crash; it was actually the day after the crash. Which, for those of us who were around then, remember that was actually worse at one point. And what I like to remind people is, that I think a lot of equity investors believe that the Fed put is designed to protect the stock market. And my assertion has always been, it isn't. It's not about stocks. It's about the other unspoken aspects of the Fed's dual mandate. The stability of the banking system, the stability of the finance and payment system, and all these other things, and the economy overall. It does play into it. And so, yes, that can help the stock market if the Fed gets active, but I think a lot of times people expect the Fed put to be there when it isn't. And the question I always ask people is, tell me what the strike price is on the Fed put, and tell me, right? So that's the gist of it.
Got it.
So can I just jump in there and say that, Steve, I love to see your presentation, because I was at Shearson Lehman Brothers a few blocks away during that same day in 1987 down in New York City. And you're absolutely right. It was that one sentence statement that Greenspan put out as the Fed chairman, that the Fed stands ready, willing, and able to assist anybody under any circumstance. That was really the Fed put, because all the stocks had started closing. And then MMI futures, remember those, Steve? The the MMI major market index futures reopened, limit up, and the market turned around that day. And we've had a Fed put ever since. I think you're absolutely right.
The statement.
Yeah.
It was more than the statement. It was basically, I don't want to go into the whole thing right now, but the Fed basically backstopped Solomon Brothers, Goldman Sachs, and Morgan Stanley, and said, and the Stanley Shopcorn came out, cigar smoke emanating out of the room, and it was, I want all you, and I'll leave some of the saltier language out, figure out what it would take to open your stocks that are basically offer only, and just stick a bid out there for them. Just put a bid out there. We did it. Morgan Stanley did it. Goldman Sachs did it simultaneously at the same time that Greenspan made that statement. That was all the market needed to, that was what the market did. We actually bought very little. We didn't buy nearly, that much stock then, because just in those days on a floor, everybody shows up with that question, or a NASDAQ where everybody was just fleeing, off the bids and just leaving them there and buying stuff. that was enough to get the market turned around. But boy, was that scary, because it really did feel like the financial system was going to come to a halt. And I don't hope we didn't go too far. I'll expand on this in our talk, Mike. Sorry,
yeah,
Jim.
Mike, I'll just say real quick. I think that that's an excellent topic, because this event, the day after the stock market crash in '87, is an extraordinarily important event in financial market history that needs to be appreciated.
Yeah. Well, listen, I mean, fascinating discussion here. We've covered a little bit of everything: market history, gold, stocks, AI. Wonderful time. If you're watching this, viewers, the reason Steve and Jim are joining me here, both of them are going to be speaking at our upcoming events. We've got Steve at the Orlando Money Show, which is set for October 16th to 18th at the Omni there in Southwest Orlando. And we're fortunate to have Jim joining us for the Sarasota Symposium event. That's going to be December 1st to 3rd at the Ritz-Carlton here, downtown Sarasota. Gentlemen, again, thank you so much for your time. Looking forward to talking and catching up with markets at those events.
Thank you.
Thank you. Thank you, Mike. Looking forward to it.